Hi, welcome back everybody to the panel discussions presented by Bamboo. As you know, we are a few months into recording these and diving into different topics around wealth tech. We've got a couple of great guests today, and we're looking at that hyper-personalization in digital wealth, and we'll be excited to see their thoughts on it. So let me introduce the first guests. And before I do that, I'll just give you a quick overview of the panel. So we'll do a little introduction. We'll have some questions, and then we'll do a summary. So throwing it over to the people. Giorgio, why don't I ask you to introduce yourself first?
Sure. So my name is Giorgio Carlino. I'm in the fintech business and in the education business. So I'm trying to split myself in improving financial literacy and also in improving return. So one side is the institutional investor, where we approach them with our strategy using fintech, so AI and machine learning. And on the other side, educating the population, I would say, about the knowledge and how to invest and how to approach financial market and portfolio construction.
Fantastic.
20 years of experience. I worked in Italy, in Germany, in New York for 7 years up to the 2020. And since 1 year, I'm back in Rome.
Great. Well, that will give us a good view. 20 years in the industry and trying to solve financial literacy. That's great. It'll give us a good overview. And Robert?
No, so just to introduce myself, my name's Robert Room. I'm a principal consultant in the wealth management and private banking practice at Psionic, which is a global consultancy in London, New York, and in Switzerland that helps wealth managers and private banks kind of grapple with some of the challenges that they're facing today, whether that's what digital means, whether that's the operating models, whether that's how they engage a kind of new generation of clients. My background's very much, again, within wealth, so within wealth management for 16 years, both in the industry for firms such as Barclays Wealth, but also more recently in wealth tech firms as well, particularly around the CRM and kind of single view of clients.
Makes sense. Cool. And today, so Giorgio is in Rome, Robert is in London, and I today am in LA. So we've got a pretty international panel. So we've been looking at this hyper-personalization. We're going to have three of the main questions that we are looking at today. So these are the problem. I think we can all see that how the consumer wants to interact with digital wealth has changed. And I think even if we look at number three here, I think they're being quicker to adapt, but still it's not truly personal. When we look at other forms of technology, be that Netflix, social media, or a whole range, they are really becoming personal. And I don't think wealth has yet got there. And I think, as Giorgio was saying, financial literacy has to be customized because the realities of finance for each of us, even though there are good standards, are different. So let's dive into the kind of questions that we're going to be looking at today. So we're going to be going through three different, which is ideas and thoughts on the increase in personalization in financial advice. We'll look at some examples, and then maybe from the companies themselves, what are they doing? So we'll go right into the first question. And maybe Giorgio, we'll start with you. I mean, as you mentioned, financial literacy is a great challenge. It's going to be ongoing. And you've been in asset management for 20 years in many different countries. And, you talked about AI and focusing on that today. As we think about this, whether the word's hyper-personalization or exactly where it is, Giorgio, how would you think about it in terms of how we've progressed and some of your thoughts on personalization, particularly in financial advice and digital wealth?
I have to say, actually, that are probably, from my experience, two different worlds, right? There is the US, where actually I think there is quite enough of supply of this personalization of financial advice. And I'm thinking about Wealthfront or Betterment or Wealthsimple, where they give you a lot of solutions and they really try to understand you quickly with an app. So intuitive, it's quick, it's dynamic, it's young, so it's easy to do. And then you move to the old Europe, where this offer is really behind. There's no a competitor like those giants in US. Someone tried, and I tried I have to say, in a poor way, so I'm not going to mention any name, but there's no personalization whatsoever, and the price is too high. So the higher personalization and the customization to the single final client that has the 100 euros to 1,000 euros to start with has to be automized. So the robot advisory of this world, we are not there yet. So the price is really high. customization is not existing because they usually have like 3 profiles or 5 profiles, and that's it. And it's true. At the end of the story, we know that probably 5 profiles is all you need, and every one of us will enter on one of those. But you can do much better in giving the feeling to the people that you're taking care of their own needs and not just a generic answer to the mass production of this product. But so at the end, we are moving there. Europe is really behind. And since I moved back, I noticed how much space there is for this big company. But the investment is huge, and probably there is not enough money to put to start with, because you will need a market that is big enough, right? US has this major advantage. Just speak one language. It's one gigantic country with a lot of millions of people. And so the return on investment is quicker. In Europe, you need to customize for different regulation, UK, Italy, Germany, France. There's no one market. So you need to respond to so many different rules, and every country is not big enough to have this scalability. But hopefully we'll get there, and the regulator has to help, I think, simplifying the difference within the different countries.
I think it's a great point. You know, as mentioned, I'm in America right now, and you're right. Huge market, everybody invests, homogenous, one language, one regulator, you know, and with tech that grows. If you look at China, one incredibly huge market, one language there, and these apps have boomed. And you're right, Europe has been a challenge. I mean, Robert, as a consultant, you know, you talk to people about trying to solve these problems. And you know, despite the fact UK and Europe not being exactly the same anymore, that's a different topic of conversation. We won't go there today. But the UK seems to, whether it's nutmeg, or do you think the UK is different? Or I'd be interested in your thoughts on what Giorgio was saying there.
No, I think that was a really good point from Giorgio. That I think that kind of the adoption of some of the technologies behind, and this kind of concept of hyper-personalized advice is really different regionally, and even within Europe, I think it's slightly differently. But it's interesting that you mentioned robo-advisors, because for me, that's always been a bit of a misnomer, particularly in the UK market. People think of nutmeg and they go robo-advisor, but actually, from a regulatory perspective, nutmeg does not provide full regulated advice in the UK. It's actually a reasonably simple model. You know, exactly as Giorgio said, they've got a couple of models. You answer a basic questionnaire, and it makes a suggestion on which model to put you in. So I think in terms of the markets in Europe, they are, I think, behind, even with some of those areas like in the UK with robo-advice, which I think is a step forward from where you are, particularly in Asia, and you said in North America. And I think part of that is a fear of regulation as well. And I think that kind of the regulatory landscape in Europe is, I think, a little bit tighter, and it's also different. And the appetite that regulators have in each jurisdiction in Europe, even if you've fundamentally got MiFID II, is slightly different. And so I think firms have held off slightly on this kind of hyper-personalized advice, because essentially you're getting very close to kind of getting into the realm of whether something is suitable and appropriate. And there's a lot of kind of baggage and thought that needs to go into that when you're actually making a recommendation to a client, particularly when you think about regulations such as MiFID II. So I think that slightly fragmented market, the regulations within the market, and that slight fear that you get within firms about making those formal recommendations has kind of held back, I think, Europe slightly on that kind of journey to hyper-personalization.
But is there, and maybe staying on this, and Robert, maybe a question and follow up with Giorgio. How much does a regulator need to catch up? Because I agree. So at Bamboo, we've deployed in Asia, Europe, and America. And we do often hear, exactly as you say, Robert, is that, oh, we don't want to over-personalize because it could stray into the wrong type of advice, suitability, it's complex. And, you know, that area, I mean, I don't want to say, do you think there's more the regulators can be doing, but how do we cross that chasm? Because other countries have done it. Like, you do see more personalization in other regions. Is there like a step change or something that Europe could be doing to make it? Because we hear what you're saying quite often. How do we take that step forward?
No, I think it's a really good point about the engagement from the regulators. And I know particularly in the UK, through something like the FCA Sandbox, there are a couple of firms that, such as Multiply, that have made it through that recently, offering something much closer to fully regulated advice. And so I think the regulator is kind of keen to get involved and to open the market up. People talk about the advice gap a lot here in the UK, the idea that you have this very underserved segment who can't access advice. And so the regulator's keen to kind of get solutions out there to help firms. But I think, as you said, it still kind of holds back some of the kind of the more incumbents within the industry from taking that leap forwards. I don't necessarily think it's just something the regulator can do. I think the being very open with people that they are open to experimenting with these ideas and maybe even expanding the sandbox. There's been a bit of a glut trying to get into the sandbox recently in the UK would help. But I think also the change needs to come from firms themselves. A lot of the resistance we see kind of the digital or to kind of next best actions and kind of what we think of as kind of some of the tools behind hyper-personalization comes as much from the incumbent firms themselves and their staff as it does from the regulator. And I think kind of taking that step forwards, realizing that there are other ways of kind of doing this, that there are other models that they can think about, I think is really important as well. So kind of meeting halfway between the regulator and the firms to kind of be able to enact that change.
Yeah, we've heard this advice gap all the time. And I think for hyper-personalization, you know, the people who don't get advice are the people who need it. And that's incredibly clear. I mean, Giorgio in Italy, is it the same? I'm sure it's different, but you're right. We did actually interact with an Italian bank. We won't name names. And it did seem, like you said it was years behind. We got that same feeling too, that there were just so many obstacles, whether it was legacy tech or regulated, or, you know, I think from what we saw was the people are not crying out for it, but need it. But Giorgio, do you see the same as Robert was saying, the advice gap and some of the challenges?
I mean, we know the challenge, right? It's about money, how much money you have. So below a certain point, you don't get any service because you cannot afford the good quality service that will require. And you don't have enough money. I mean, I recently wrote an article on the Sole 24 Ore, the FT of Italy, and this is exactly about that. There is a line, and below 100,000, you cannot get a decent service in Italy because they have no money to pay for their service. And so that's where the tech should help us. But in this case, it has to be, I agree with Robert, there has to be a double push, right? We need to push the regulator to do something that makes it easier for people that have the knowledge and the fintech ability to serve 100,000 of people, but it cannot be the way that they ask now to the asset management company or the consultant. It's very difficult to go out and tell something to someone. I mean, I have not a joke, but it's kind of a story, because I came back after 20 years of investment from New York, and I went to the Italian regulator and I said, I would like to give advice to people about investing. They said, I don't pass the minimum requirement, right? I was managing 150 billion, and I had clients everywhere, including Italy, right? Pension fund, public pension fund were under my supervision, but the regulator said, sorry, you don't pass the test because you didn't work in the European country for the last 8 years. So we don't know what you were doing in New York. So it's a bit of a joke, but this is gives you the idea how difficult it is to get people to serve clients properly, and how the regulator is kind of blindsided to give the rules that I would just almost say like nonsense rules.
Yeah, and look, I think it's a great point, because the reality is wealth was never set up to serve the masses. That's the reality. It was set up to serve the people with hundreds of thousands or millions of dollars. And and almost I'm wondering whether you have to almost start again and say, look, the people who need advice the most, the 21-year-old who just started their first job and has $100 to invest, the fact that they don't start, and maybe leads on to the second question that we have, which is then starting to look at some examples of how personalized financial advice can work in the future. Giorgio, I mean, look, you're working with some startups. How does it work? So let's say we can get over these challenges of the regulators and we can get over them. What examples would you give, or and I know, as you're saying, you're looking at AI in different ways, how would you perceive that it can work in the future?
I mean, again, to me, they had just to copy what has been done already in the US. Like you look at the Wealthfront and Betterment, and you open the app, and it seems that work for them, but I don't. I just use that as a user, and it's so convenient. And now they add even more flexibility. They really come to you and say, "Are you, an ESG fund? Like you want to make your portfolio really help in the future?" And they give you a setup that will achieve your return target while taking care of this other one with 2 clicks. So very, very easy. And that's what we need to do in Europe, because the people with 100 euros, 1,000 euros, they need that kind of service. It's something that is easy to use, really handy, and that's where we need to go. But it requires a gigantic investment at the beginning. And that's what I think is missing. And I actually called Wealthfront to say whether to come to Europe. And they said that we have enough property now to grow the business in US. And as we said before, Europe is so fragmented that the return on investment is not exciting for some giant like Wealthfront.
Yeah, like I think that reality of Europe is, I suppose it's like kind of the market whereby being segmented, it is hard to make the commercials that reality from that reality. I mean, Robert, from your side, again, you've looked at this from a range of different angles. What examples do you think could work from that future of the personalized advice?
I think it was an interesting point you made about kind of financial literacy earlier on, and there's lots of stats you can quote, but I think there was a recent one that kind of 46% of adults in the UK didn't feel that they were kind of capable of making an investment decision. And it's all well and good giving people investment recommendations and personalized advice, but if they don't understand the context of what they're being given, they don't understand the products that they're being kind of suggested, it doesn't really necessarily lead to better outcomes. And so I think kind of melding this idea of kind of financial literacy with the hyper-personalization, so that alongside delivering, here's a product that might work for you, have you thought about this? Here's some advice. We know that your skill level isn't that high. Here's some training material you can have a read, or here's a blog post you can have a kind of look at. Here's a little video that will tell you, in 60 seconds about the products so you understand them in a bit more depth. So I think merging together that idea of financial literacy with that hyper-personalization, I think has a lot of opportunity. And you see that kind of financial literacy piece in apps like Finimize, which have got quite a lot of traction in the UK market. And I think melding that together with the kind of the personalized advice, I think is kind of one key bit. The other bit for me is really looking at what you're using to provide that personalized advice as well. What are you using to provide that kind of the view of the client? And at the end of the day, firms at the moment, they use the KYC data they've got to try and work out what to recommend. And Giorgio, you made a good point about ESG there. We're starting to build up ESG and understanding of kind of the ESG preferences of clients. But I think the other piece that I've seen that I find really interesting is actually deeper goal planning. So really drilling into what someone's goals are. So not you want to retire at 60 and you want, £2,000 a month to live on, but really drilling into what someone's life goals are, exactly how much money and capital they will need to meet those. I've seen some interesting goal planning solutions that look, for example, based on your health and the probability of something, perhaps you falling ill in a way that means you have to leave your job early or retire early, and then modeling out what that potentially might mean for your kind of retirement pot and what your retirement living might look like. So I think that's another key area for me that you can bring in, is much more sophisticated goal planning, and kind of using that to generate deeper KYC and therefore better recommendations. And if you combine that with how much literacy the clients have and kind of tailored insight and content to help them uplift that, I think you've got a really kind of strong proposition.
It's a great point. Like I do think that goal planning being better, but I'm going to throw maybe a provocative question or a question back at both of you. I've thought about this a bit. So we've been, people have been trying to save money for retirement, let's just say for hundreds of years. Again, stop my 100 years. Yet still 46% of people in the UK, roughly that number, half the people don't get it. Should we abandon financial literacy and do this instead? Netflix doesn't ask us. Netflix doesn't come and say, what do you want to watch? It just tells us. It figures it out and it says. I'm wondering if financial education is just not too hard, or it is not palatable, is the other option we just take all the data? Hey, for example, Robert, we know what you earn, we know how many kids you've got, we know, like Google. Think about it, if Google launched a wealth management app, I don't think they'd ask you any questions. It would say, hey, Robert, here's the plan, click yes, and you don't have to think about it, because even though I know it's always been, you need to own your own financial destiny, because most of us, it appears, or at least half of us are not very good at it, why don't we reverse it and just say, hey, look, we got you? Because for most people, it's pretty simple. Let's see what you earn. Do you think is it too far a step to say financial literacy is too hard? Or I don't know, do either of you have a feedback on that?
No, I mean, I feel strongly about that. Like, I don't think it's too hard, right? It's presented like something hard, but the basic knowledge to invest, it's basic knowledge. It's like, 2 + 2. The problem is we don't teach that at a high school, and that's what it should be taught. So let's start with like adding an hour a week. That doesn't take that long to give the basic, or like what is risk premium, how you diversify portfolio. Basic knowledge is like math. It's not really sophisticated. It's, I mean, the compounding effect of the return, and that's it. So this is, I think we should do it, but we should start at school so people don't have this fear of the financial market and all this movie that they watch, right? Because that's what they have, the Wolf of Wall Street in their mind. And the other one is like not the opposite, but the other solution is like, okay, let's give out all our data and let's just forget about privacy. And then someone will know exactly what is my right plan for everything. And I'm in that camp, but it's a bit extremist. And I understand like a lot of people don't want to share all this data. And they say, if I'm sick, I don't want the health insurance to know. Yeah. But, you know, if we know better, then we can forecast better. And so, of course, also the financial plan will be pretty easy if I have more information about you. But that means, you know, sharing data. And that's a major problem. So
I think your point about school is so true, Giorgio. Like, it's crazy. Like at my company at Bamboo, most people are in their 20s. And even though they work at a robo-advisory company, in general, they say, oh, yeah, no, I'm too early to start saving, or, oh, it's not for me, or I'll do it later, or I don't understand it to a degree. You know, you're right. I think that's such a good point, is that it isn't that it's too hard, but maybe we just haven't done a good job with explaining it. And you're right. I think the fact that kids leave school and have been given no real life financial training is crazy. I mean, Robert,
let me make just a little commercial. So this company, Mass4, so it's a bunch of practitioners, right, with 20 years of experience, not myself, but 6 of us. So we put together a course of 4 hours, like 4 hours. And in these 4 hours, you get all you need to know to start investing. It's called Math for Beginners. So like beginners, you start from scratch, you don't know anything. You get what is a financial market, some behavioral finance, and how to build a portfolio. That's the 3, you know, things that you need to know. And that's it. It's really not that complicated.
And I mean, I agree. It definitely isn't. But so I completely agree. Start at school. Robert, any thoughts about how we should persevere with financial literacy and make it better, or just give it all over to the data?
I think apart from your kind of previous proposition, slightly giving any regulators listening a heart attack, I think I think there is an interesting point here, which I think is you talked both about the fact that actually, if there's enough data there, you can make very intelligent decisions. You know, and open banking, particularly in Europe, and opening up that kind of the spending habits and your current and your credit accounts gives a lot of opportunity for kind of proactively almost generating people's goals, you know, understanding what they're spending and therefore what they're likely to retire, rather than having to ask them. So I think you can, your point, get some very, very targeted kind of recommendations. But I think if I flip it around, and there was an interesting article I read recently, and it finished with a quote that I can't exactly remember, but the general gist of it was, you know, that if Amazon recommends a book and you buy it and you don't like it, you either finish it or you send it back. If your investment management firm or your wealth manager recommends a product for your retirement and you buy that and it doesn't work out, it's a very different situation. And so I think the threshold for kind of moving the responsibility off the individual to the firm is very different when you're talking about investments, because the consequences are so much more substantial than in areas like Netflix or Amazon. So I think there needs to be a lot of care taken around kind of that automation of recommendations and potentially the liabilities that would arise from that. So I can't see it getting to that point that it's just Netflix, you pick, you know, what your recommendation, you don't think about it. But I think we can make the kind of, we can meet halfway. We can make the recommendations much more intelligent. I think without using an overused phrase, explainable AI, explaining to people why a recommendation's been made is really important, not just here's what we think you should buy, but here's why. And then if you meet in the middle between that and better financial literacy, as kind of Giorgio said, which is not that hard to kind of get into, particularly if you teach people at a young age, I think you can get better outcomes by kind of getting the halfway house between the two.
I think that's a great point. I love your point about the book. You're right. It's a different thing. And I think the halfway house is right. Like if we use the data to say to a young person starting work, hey, we can see you do have $100 left a month. Let us start by simply investing that for you. And as we invest it, we'll explain how it's going for you. And then, you can then understand, it gets them on the journey, because as we know, the eighth wonder of the world is compound interest. The only problem with that is most people don't get on early enough, and they miss out the critical years, which is the first 10 years. I think if we educated them earlier on, that would make a huge difference. But you're right. I think there is a good, we must do better with literacy, and we must do better with data, but to a point. You're right. It is, health and wealth are pretty critical from that side. Let's jump on to the third question that we had here. So, and I think Giorgio, you gave us already a little advert or a little insight into that. But on a previous panel, I heard about a gentleman we had on talked about all personalization and fintech is built on trust and confidence. Now, I know we have here engagement and confidence, and financial institutions could be any, technology company. I do think it's true. No amount of good UI, UX data really is going to work if you don't, because it's money, you don't have trust, confidence, and great customer engagement. Giorgio, I think, as you said, you're using AI, or I think as Robert said, maybe explainable AI. But Giorgio, how would you, what are you doing in this space that you think is relevant?
So to start with, I think the real major problem is why people are not doing the right thing with investment is trust in the counterpart. And they mistrust banks and the system for a reason, because they've been screwed for the last 30 years, right? When you buy a fund that costs 3% a year, that's clearly, it's a scam, right? We should stop it. And even now there are products out here in Europe that cost like 2% and they invest in money market, like with negative yield. How can you justify such a fee on this product? So this is again back to the regulator, because I don't think anyone that is making millions will say, okay, now enough, guys, I made enough money, let's keep it. So that should be stopped, because it's really easy to be seen that it's wrong. And so people mistrust the system. And that's why I think what is needed is real some institution that does only education, because a lot of banks are doing this education, right? You have the bank account with them and they give you like some financial literacy. At the end of the story, they're always trying to sell you some trading courses, but they give you also the right information. But people don't watch those videos, they don't follow those courses, because they think, okay, it's a bank, they're trying to sell me something. And somehow they're right? So that's why I think it should be really some independent party that is qualified and big enough to go out and educate people, and people can trust that you're giving them education and that you're not selling anything else. But that's the major effort. And this is what we're trying to do with Mass4. So we're trying to establish ourselves an education company only in financial literacy, nothing else. We don't sell consultant, we don't sell portfolio, we don't provide any advisor how to invest money. We want to just educate you, and then you go and talk with your advisor after you understood what you need to do, right? And the question you need to ask. So I think it's really helpful if there are more companies like us, because that alone will never be able to, but we need more support, and there are more companies pushing that direction, then maybe we can change what is going on now.
I think it's a great point in that, so like I used to be at E-Trade 20 years ago, and when we started E-Trade, it was so hard to get customers because people are like, oh, you're not a bank, therefore we don't trust you. Fast forward 20 years and think about it. The millennials of today were teenagers when the GFC happened, and their parents came home and were like, oh no, the world's ending financially and banks have messed up. So they, in their brains, they are like, oh, banks messed up when I was young. And, today, they trust these digital apps. So whether it's, I'm not going to say Robinhood from Trust, so that maybe that's a different one, but whether it's Betterment or Wealthfront or whatever it might be, I think to cross over to using a application that doesn't come from a bank background is much higher today. And you're right. I think right now is the most kind of fertile time, the best time to launch these products that can get trust. And I think you're right. Like, I think it comes back to another point. The wealth industry was never set up to benefit the customer. I don't think the bank is staffed with bad people and charging too much. It was just never set up. It was set up to make, financial institutions money. It wasn't set up to benefit the customer. And I think we've got to change that, right? That's because in the end of the day, as you say, taking 2% on a money market fund with a negative yield, that's not a sustainable path forward, for sure. Robert, from your side, you've seen, again, I assume as a consultant, you've seen so many different ways to take it forward? Which would you highlight?
I think you made a good point about the fintechs there, and thinking about the kind of, I suppose, the newcomers versus the incumbents. I think one of the things with a lot of the kind of the fintechs is transparency. They are very transparent about what they're doing, or in the majority of cases, they're pretty transparent about what they're doing. And I think a combination of kind of regulation, but also I think a drive from wealth management firms in the UK and in Europe more broadly, has seen kind of that transparency come through. So whether that's the costs and charges, from MiFID II, in terms of just making it kind of with firms having to be clearer on exactly what fees they're charging and what the impact of those fees are on portfolios. But we're seeing firms starting to go further in terms of being transparent around how those fees are calculated, what those mean. Also transparency around how the firms are actually looking to meet the client goals. So back to the point I made about goals earlier, it's not just here's your portfolio, here's how much it's gone up, and here's the change that represents. Well, here's how much the fees have eaten into that. It's here's how we're doing against the goals you told us about. Here's how on track we are meeting your requirements. And I think through transparency you build trust, and I think that's the key thing for me is that you've got firms now trying to be more transparent with their customers. I think increasingly you're seeing firms talking about the voice of the customer, or chief customer officers or chief experience officers, and having someone in the firm kind of taking the client side, if you like, thinking about the client first. We're seeing firms with client panels, having kind of key clients kind of feeding into initiatives and kind of projects and new initiative and new kind of product launches from firms. So kind of bringing the clients a little bit more in, kind of comment on how firms are doing, build that kind of trust through that transparency, gaining trust as well. So I think we are seeing that shift very much towards, to your point, not necessarily putting the firm first or being seen to put the firm first, but being seen to put the customer first.
Somebody asked me a question the other day. So as Bamboo, we build robo-advisory solutions for people with the technology. Somebody said, does any robo actually care? And again, for all the robos out there, I'm not having to go at you, I'm just saying as it was said. Let's say you put your money in Betterment, Wealthfront, Nutmeg, and you save for retirement for $1 million in 20 years. And in 20 years, you don't retire with $1 million. Does any robo actually care? Is there any penalty? Is there anybody? Because that's, I think, the problem with goals. Quite often, it's just a fanciful name for something. And whether you achieve it or not, the robo actually doesn't do that. It actually just buys you funds which go up and down. In essence, I'm wondering whether we move to a place where the actual achievement of goal is the deciding factor on whether that was good for you. Because I've used this before. Nobody wakes up in the morning and thinks, oh, I want to buy a balanced equity portfolio today. It's not how humans work, right? They want to achieve their goals, yet almost all digital wealth platforms rebalance to, returns on the market. Or I don't know, like, should we move to a place whereby the actual outcome, and Robert, maybe throwing it back to you were saying it's achievement of goal, but I don't think many people have got there yet as the deciding factor of what they've delivered to a customer.
No, I'd agree with you. I think that the more traditional wealth businesses, and particularly financial planning in the UK, which is kind of very centered around kind of goals and outcomes, even if perhaps the tools aren't always the most sophisticated, does try and put that first. But it's a very long time frame to be measured on. And so I think, to your point, people tend to focus on the short-term measurements, which is how's the performance over the last 3 to 5 years, how are we doing against the wider market? But that's not, as you said, necessarily the right thing for the clients. I'm a Nutmeg customer. I don't put money in Nutmeg, and then monitor the performance. What I care about is whether I'm going to retire with an amount of money that allows me to live comfortably. That's my goal. That's why I'm saving with them. And I think having more of that focus on kind of, are you helping your clients achieve their outcomes, being transparent with them about whether they're on track for that or not, and using personalization to kind of help nudge them in the right direction if they're not, I think is very much the kind of future if you can get there.
Fair enough. Makes sense. Well, look, guys, we're coming up towards the end. I always like to kind of have like a 1-minute wrap up from each of us on there. So maybe Giorgio, just as we've looked at personalization. It's only been a short discussion. I'm sure we could carry on discussing this, but maybe let's say it's 10 years in the future, right? And we meet up again on the wonderful world of Zoom, which we all now seem to live on. What would you hope for? What would you say? This has been success. We've actually moved financial advice and the customer is first. Maybe what's your hopes for the next kind of 10 years or in 10 years time? If we're able to look back and say, yeah, I think financial advice is now working for the customer. Giorgio, what would be your criteria for that financial advice having, made the right steps forward?
I think probably if I know exactly how much I spend for that service. That's the target should be that I know how much is worth it and that I know why I'm spending those money, right? And also to respond to your question before, we cannot control the outcome, right? We are in the world that we don't know. I mean, we can say risk premium 6% a year for the next 20 years. And so I do the calculation like that. And usually you're right. When 20 years, it could be down 10% from where we are today because we really don't know. It's a probability game you are playing with the history that we learn. So with our best information we have today, that's what we can do and give you the highest probability to achieve your outcome and what's your goal. But we cannot guarantee. So that's why also it's very difficult to judge afterwards if I did a good job. And that's, back to the fact that it's a difficult business because the people don't have enough element to judge us. How do they judge a good service versus a bad service? They judge only on the outcome and on the performance. And if you talk to the guys now, they're really happy with their financial advisor because the last 10 years they went up 10% per year. But it was nothing related to the financial advisor, right? It's just the market. So it's very difficult. So I hope in an ideal world, we have clients that are aware and that can judge and understand what is a good service versus what is a bad service, regardless of the next year performance and 2 years performance. I know it's very ideal, but I think really education is the base for all of it. The more people are informed and understand, the better we'll be able to judge and understand how much my service is worth it.
That's a great point. Like, I think if people can actually judge, irrespective of market performance, if they got a good service, that would be great. I think, that would be great. And Robert?
No, I think it's very much just kind of reinforcing what was said already. And I did a little bit of research before the call and had a look at a few press releases about next best actions and hyper-personalization. And it was interesting that a lot of the vendor and the firm kind of press releases spoke about X increase in sales or X increase in calls. And it was very much focused, again, as we talked about, on the firm doing more with their clients, the firm selling more, the firm making more revenue, the firm reducing operating costs, and it wasn't client-centric. And I think for me, if hyper-personalization, which is very much about kind of understanding people and offering them kind of advice that fits for them, is going to really work, it can't just be about firms selling more, it's got to be about client outcomes, even if that, as Giorgio said, is very, very hard to measure, and in reality, you can't guarantee outcomes. But I think if in 10 years, firms are talking about whether the way they're communicating and the way they're engaging clients is helping them or be more likely to achieve their goals rather than necessarily talk about operational efficiencies internally, that would be a good outcome for me.
That makes sense. Yeah, look, I'll put a note in my diary for whatever date we are today, Wednesday, the 29th of September in 2031, see if we're all still going and doing stuff, and we can look back on this and see if we were close or not to being correct. But Robert and Giorgio, thank you so much. Really appreciate you being on this webinar, and thanks for joining. Thanks, guys.